This video offers insights and inspiration on an easy-to-follow path for reviewing your business financial statements using a practice case study, the importance of comparing current year performance against another measure, such as a budget, prior year financial statement, or similar-sized businesses in your industry. Questions to consider as you review key line items of the financial statements, suggestions for improving financial performance in key areas. Why review business financial statements? An investment of time to regularly review your financial statements will result in making better decisions for your business. It puts more control in your hands, and ultimately, that control allows you a better chance of building wealth in your business. But what if you don't know where to begin? Well, this video will guide you as you read a set of financial statements. Now, practice is the key to becoming comfortable and proficient in any discipline. So let's start by walking through a case study income statement and a balance sheet. Each step we take with the case study can be applied to your own set of financial statements. An income statement reports income and expense activity for a specified period of time, such as a month, a quarter, or year. It's hard to tell if the results are good or bad unless it's compared to something else. How does this period compare to last period? How does it compare to budget? What's the trend? The information in an income statement is more meaningful when there's a yardstick to measure it against. Our case study allows us to compare the current year performance against budget and the prior year. For each of the following line items, questions will be raised that spark exploration of what's happening, why it's happening, and what should be considered if improvement is needed. You've got sales, cost of goods sold, gross profit, operating expenses, other income, other expense, income before tax, tax, net income, also called net profit. Sales. Okay, so in our case study, sales were $515,000 in the prior year. The owner projected sales to increase 8% to $556,200. Actual sales for the current year are $566,500, which is 10% higher than the prior year. Sales are higher than budgeted and higher than the prior year. Questions to ask yourself as you review your sales performance. Is this what I expected to do in sales? If it's not what I expected, is it better or worse? In either case, why is it better or worse? If worse, do I really know who my customer is? How will I be able to maintain or improve sales? Cost of goods sold are the direct costs the business incurred for the product sold. Examples include materials used to create the product, charges to ship the product, and merchant fees assessed when customers purchase the product with a credit card. Now keep in mind, not all businesses have cost of goods sold. Case study. So in the prior year, cost of goods sold was 71% of sales. Cost of goods sold over sales equals $365,650 over $515,000 equals 71%. The owner projected that cost of goods sold would stay at 71% of sales. Budgeted sales of $556,200 times 0.71 equals $394,902. Current year cost of goods sold is 73% of sales. The cost of goods sold dollar amount is higher because sales increased. However, cost of goods sold as a percentage of sales increased at a higher rate, leaving less gross profit than budgeted, as we will see next. Questions to ask yourself as you review your cost of goods sold performance. Does this number look accurate? Is it growing proportionately with sales? Have all inventory adjustments been made so that cost of goods sold accurately reflects the cost of the sales made in the same period? How does your cost of goods sold compare with other businesses in your same industry? If your cost of goods sold is higher, consider actions you can take to improve it, such as asking suppliers about better pricing or raise the selling price of your product. Gross profit is income left over after paying for the cost of the sale. Gross profit is used to pay for the operating expenses of the business. Gross profit margin is calculated as gross profit divided by sales. So, in our case study, prior year gross profit of $149,350 was 29% of sales, meaning for every dollar of sales, there was 29 cents in gross profit. The budget projected the same percentage of gross profit. However, because cost of goods sold was at a higher rate in the current year, gross profit dropped to 27% of sales, resulting in $8,343 less of gross profit dollars than budgeted. Here are some questions to ask yourself as you review your gross profit performance. Gross profit is a key figure for reaching profitability of the business. You must generate enough gross profit to pay for all the operating expenses of the business and leave a net profit. If the gross profit is more or less than expected, ask yourself why. If it's more and you know why, are you able to continue to perform at this level? If it's less and you know why, are you able to make one or more changes that will improve it, such as implement a price increase of your product or service, increase sales volume, reduce cost of goods sold by negotiating with current vendors, or seek new vendors? Operating expenses are the general expenses of running a business. Overall, in this business, the operating expenses have remained fairly consistent as a percentage of sales. The budget included a slight decrease in operating expenses as a percentage of sales from 26% in the prior year to 25%. Actual results were even better at 24%. This will prove helpful for the bottom line since gross profit was less than expected. Questions to ask yourself as you review your operating expenses. Are total expenses within budget and properly categorized? If total expenses are higher than expected, where was the extra expense incurred? Were extra expenses justified? What adjustments do I need to make going forward to maintain my goal for profitability? Operating profit is profit before taxes from the normal operations of the business. So, in the case study, the owner projected an increase in operating profit from 3% of sales in the prior year to 4%. A business that's growing its sales and is able to maintain costs will experience an increasing operating profit. In the current year, operating profit was $14,261, lower than budgeted by $8,378. Even though operating expenses as a percentage of sales were down 1%, cost of goods sold increased 2%, thereby reducing overall operating profit. Questions to ask yourself as you review your operating profit. Did my business generate a profit from the normal operations of the business? If so, is it what I projected? If not, why? Sales lower than expected? Cost of goods sold higher than expected? Operating expenses higher than expected? What steps can I take to improve the operating profit of my business? Consider these options. Increase sales volume, increase price of product or service, reassess vendor-supplier relationship if cost of goods sold is high, and review operating expense line items for potential reductions. Looking forward, do I expect any increases in cost of goods sold or operating expenses that should be factored into my profitability plan? Other income and other expense is income or expense that did not come from the normal operations of the business, also known as non-recurring or extraordinary income and expenses. An example of other income is a gain on the sale of an asset. Interest expense from borrowing money is an example of other expense. In the case study, in the prior year, the business sold an asset and realized $4,000 of other income that would not be recurring each year. Also, the business has debt, and the interest paid is recorded as other expense. Questions to ask yourself as you review your other income and expense. Am I relying on other income to cover my operating expenses and/or generate a profit? If so, what happens if other income goes away? Have I generated enough operating income to cover an extraordinary expense? Are other expenses not related to the normal operations of the business eating away at my bottom line? If so, what are my options to improve? Income before tax, also called profit before tax, is the amount left over after all expenses of the business except income taxes have been paid. Case study. In the prior year, the business made $18,080 income before tax, 4% of sales. The budget called for $20,239, 4% of sales. The actual result was $12,061, 2% of sales. Questions to ask yourself as you review your income before tax. Did I make my goal for net income before tax? How does my net income before tax compare with prior year? Will I need to make any changes to my operations to improve or maintain my profitability next year? Tax. Tax on income of the business. Depending on the legal structure of the business income before tax may pass through to the owner and be claimed and taxed at the owner's individual rate. Case study. In the current year, the business made a profit of $12,061, 2% of sales. The tax that will need to be paid from cash is $1,688. Here are some questions to ask yourself as you review your tax. Have I planned for taxes by setting aside a cash reserve to pay them? Have I consulted with a professional financial and tax advisor to help me manage the profits and tax of my business? Am I taking advantage of small business tax credits? Net income, also called net profit, is the amount left over after all expenses of the business, including income taxes, have been paid. So, in the case study, in the prior year, the business made $15,580 in net profit, which was 3% of total sales and included one-time income from the sale of an asset. In the budget, the owner planned to increase sales and maintain 3% net profitability. Actual net income of $10,373 was 2% of sales. Now here's the bottom line. Sales increased and exceeded budget, but profitability was $7,033 below budget due to increased cost of goods sold. Profit is important. It can be used in three ways: to pay down debt, reinvest in the business, and pay the owners. Questions to ask yourself as you review your net income. Did I have a net profit or a net loss? If a net loss, was the loss expected? If not, why was there a loss? What events or decisions contributed to the loss? What steps can I take to make a profit next year? If I had a profit, what's the best use for the profits of my business? Balance sheet. Now let's look at the balance sheet for this business. A business buys assets such as inventory or equipment for the purpose of generating sales and income. Those assets are paid with either borrowed money or owner equity. All that information is reported on the balance sheet. Over time, if managed properly, the owner can build equity in the business. The ability of the business to generate enough cash to pay bills coming due is managed on the balance sheet, not on the income statement. A good balance sheet manager has a better chance of weathering economic downturns. For each of these line items, questions will be raised that spark exploration of what's happening, why it's happening, and what should be considered if improvement is needed. You've got current assets, fixed assets, total assets, current liabilities, long-term liabilities, total liabilities, retained earnings, net worth, also known as owner equity, total liabilities, and net worth. Current assets are cash and assets easily converted to cash within 12 months, such as accounts receivable or inventory. In our case study, current assets have increased to $150,815 from the prior year of $119,850. The business is holding less cash but more accounts receivable and inventory. Here are some questions to ask yourself as you review your current assets. Does my total current assets amount look correct? What is my cash position? Is it stable, growing, or is it declining? Are all my account receivables collectible? Are there any calls I should make to collect receivables that are beyond term? Does my inventory figure look correct? Do I have a good inventory management system in place? Is a physical inventory count needed? Do I have any stagnant or obsolete inventory I should discount to move quickly? Fixed assets are longer-term assets a business purchases to support generating sales. Two examples include equipment purchased to manufacture products and vehicles used by employees to make sales calls. In our case study, net fixed assets have declined from $105,385 in prior year to $89,385 in the current year. This is due to accumulated depreciation of $89,000, and no new fixed assets were purchased. Fixed assets depreciate or lose value over their useful life, and the reduced value is reflected in the line item less accumulated depreciation. The IRS provides published guidelines for calculating depreciation. And now, total assets add together current assets, fixed assets, and any other assets that don't fit these two categories to arrive at total assets. Other assets may include intangibles such as goodwill or the value of a patent. In the case study, total assets have increased from $225,235 to $240,200. The business had growth in accounts receivable and inventory, but had a decline in net value of fixed assets. Current liabilities are payments due within the next 12 months, such as accounts payable, principal payments on bank or investor loans, or accrued expenses such as payroll taxes. In the case study, total current liabilities increased from $63,751 to $79,014. New in the current year is a $5,000 note payable to the bank. Accounts payable trade increased $8,843 to $44,843. The business used bank and vendor credit to finance the purchase of more inventory and to carry more accounts receivable. Questions to ask yourself as you review your current liabilities. Does my current liabilities amount look correct? Do I have enough current assets to cover the current liabilities? If not, consider options such as manage expenses, move short-term debt to long-term if appropriate, increase current assets by locking in pending sales with an invoice to increase accounts receivable, sell more existing inventory before buying new inventory. Long-term liabilities are obligations that are due beyond 1 year. In the case study, the business has a long-term loan from a bank and a loan from an owner called a shareholder note. The long-term liabilities have decreased from $57,113 to $46,442 due to steady repayment of principal on the long-term loan and no new debt added. A note about long-term debt and current portion of long-term debt. Now, a loan that will be repaid over a period longer than a year will be split in two amounts on the balance sheet. The principal payments due in the next 12 months will be reported as current portion, long-term debt. In the current year, $10,671 will be paid in the next 12 months. The remaining principal balance that is due beyond 12 months is reported as a long-term liability. In this case, it is $11,442. It's important to understand what amount of principal will need to be repaid in the next 12 months so that current assets can be managed to allow enough working capital to make the payments. Questions to ask yourself as you review your long-term liabilities. Do my long-term liabilities look correct? Have I reviewed the terms of my loans for opportunities to refinance at a lower rate if warranted? Will I have any financing needs in the near future? If yes, will I be able to afford the payments? Total liabilities. Add together current liabilities and long-term liabilities to arrive at total liabilities. This total represents obligations that the business owes to others. The use of short-term and long-term credit helps a business owner buy assets needed to generate sales. However, overusing credit can erode profitability by saddling the business with high interest expense. In the case study, total liabilities increased $4,592 from $120,864 to $125,456. The business paid down long-term debt, but also borrowed more short-term debt to help pay for additional current assets. Retained earnings is profit that's been left in the business since it started. This line item is important for building equity in a business. Reinvesting profits is how a business can grow. At the end of each fiscal year, the net income after tax from the income statement is recorded on the balance sheet as retained earnings. Owner distributions of the net income are subtracted from retained earnings. Retained earnings are not necessarily reflected in cash on the balance sheet. Profits reinvested in the business in the form of retained earnings may be spent on equipment, debt repayment, or inventory, for example. If the business experiences a net loss at year-end, retained earnings are reduced by the amount of the loss. In our case study income statement, the net profit in the current year was $10,373 after tax. The profit was left in the business and there were no owner distributions. We can see that because the retained earnings increased $10,373 from $79,371 in the prior year to $89,744 in the current year. Questions to ask yourself as you review your retained earnings. Does retained earnings look accurate? Is retained earnings growing over time? What is the strategy for retained earnings for your company? Net worth, also called owner equity, is the sum of capital stock, owner's original investment, any additional capital invested by owners, and retained earnings. This is the amount the owners of the business have contributed toward the purchase of assets for the business. In the case study, we can see the net worth of this business grew by $10,373 from $104,371 to $114,744 in the current year. Questions to ask yourself as you review your net worth. Is the net worth of my business growing over time? What is my goal for net worth? Do I want to build value in this business for future sale? Total liabilities and net worth. The sum of total liabilities and net worth must equal total assets. The balance sheet must balance. A business owner buys assets to generate sales and income. The assets are paid for with borrowed money, liabilities, and owner money, net worth. In the case study, total liabilities and net worth of $240,200 in the current year equals total assets of $240,200. The balance sheet balances. What does this mean? Well, at this point in time, the owner of this business purchased $240,200 of assets to generate sales of $566,500, as shown on the income statement. The assets were paid for using borrowed money and trade credit, liabilities, of $125,456, and net worth, owner equity, of $114,744. So, practice reading your income statement and balance sheet on a regular basis. Building this as a habit will allow you to respond more quickly to changes that need to be made in order to meet your goals. Good luck.
And cash flow is king in any business. So, or said differently, revenue solves all problems. So if you have money, you can actually figure out how to manage it. If you don't have money, it's very difficult to figure out how to manage it. But I think the more important component is this idea of management of profitability. And I think most people go into small business statistically are doomed to failure. And so when we talk about this idea of profitability needs to move up in what we'd call the expense category to something that's paid first. And as a small business owner, you have to choose to be profitable. You have to decide how much you would like to make as a return on equity, return on investment, and pay that first. Now, some people were like, well, what if I don't have enough money for all my bills. Well, I would go right back to civilian life. If you don't have enough money for all your bills, what you do in civilian life is you make choices, right? So maybe you get rid of the cable, or you go down to basic, you go out to eat less, you don't go to the movies, maybe you get rid of your new flashy car and you go down to a second-hand car. That's what you do in civilian life, and that's what you need to do in business life too.
We realize the success of your business directly impacts the success of your community and its people. So we push a little harder and we care a bit more, because it's not profit for us, it's prosperity for all.